What if the most powerful currency in human history is in its final act? Right now, three things that have never happened simultaneously are happening simultaneously. The United States is drowning in debt it can never repay. The petrodollar, the system that forced the entire world to hold US dollars, is breaking apart. And SWIFT, the financial weapon America used to control global trade, has pushed the world into building an alternative. The dollar doesn't have to die overnight to lose. It just has to become optional. And that moment, the moment the world decides the dollar is optional, may be closer than anyone in mainstream finance is willing to admit. This is what comes next. Today, we're going to break this down in three parts. First, why the dollar's structural pillars are crumbling simultaneously and why this time there is no bailout. Second, why Bitcoin and gold are not rivals but twin strategic levers in the coming monetary realignment, and why Bitcoin, for all its brilliance, still cannot function as your everyday currency. And third, the piece most people in this space are sleeping on, why stablecoins are going to be the transactional bridge that carries global commerce from the old system into the new one. Let's get into it. The first pillar is the United States itself. The national debt sits above $36 trillion, and that is just the headline number. When you fold in unfunded liabilities across Social Security, Medicare, and Medicaid, some credible estimates place the real obligation north of $200 trillion. Interest payments on existing debt are now consuming more of the federal budget than the entire U.S. defense budget. The United States is no longer borrowing to invest in its future, it is borrowing to service its past. And when the Federal Reserve is eventually forced to monetize that debt at scale, to become the buyer of last resort for treasury bonds the world no longer wants, that is not a policy choice. That is the textbook opening of a hyperinflationary spiral. The fiscal position of the United States is not a problem to be managed, it is a mathematical inevitability playing out in slow motion. The second pillar is the petrodollar. For 50 years, the arrangement forged between Washington and Saudi Arabia guaranteed that global oil trade was denominated in dollars, which meant every nation on Earth needed dollars to buy energy, creating a permanent structural demand for U.S. currency regardless of America's own fiscal behavior. That arrangement is fracturing. Saudi Arabia is now settling oil trades with China in yuan. The BRICS nations are actively constructing bilateral trade corridors in local currencies. The Gulf states are hedging openly. When oil, the lifeblood of the industrial economy, no longer requires dollars to purchase, the single most powerful source of artificial dollar demand disappears. The petrodollar was the mechanism that allowed America to export its inflation to the world. Without it, that inflation comes home. The third pillar is SWIFT. When the United States froze Russia's $300 billion in sovereign foreign exchange reserves in 2022, it did not just punish Moscow. It sent a message to every central bank, every sovereign wealth fund, and every government treasury on Earth. Dollar-denominated assets are not neutral, they are a geopolitical weapon. And if you're on the wrong side of Washington, they can be seized with a keystroke. The response has been systematic and accelerating. China's SIP system is expanding. Russia and Iran are settling bilaterally outside dollar rails. India is experimenting with rupee-based trade. Central banks globally are accumulating gold at levels not seen since the 1960s. The weaponization of SWIFT was meant to project power. What it actually did was trigger the most significant de-dollarization movement in modern history. The world is building the exits, quietly, deliberately, and with urgency. Here is where the conversation needs to mature, because too much of this space frames Bitcoin and gold as competitors fighting for the same throne. That framing is wrong, and it costs people clarity at exactly the moment when clarity matters most. Bitcoin and gold are not rivals. They are two distinct strategic levers, both serving the same macro function, a sovereign exit from fiat dependency, but operating with different characteristics, different risk profiles, and different roles in a rational portfolio and a rational monetary system. Smart sovereign actors and smart individual investors are reaching for both. Gold's case is ancient and self-evident. It has held purchasing power across 5,000 years of human civilization, across the collapse of every empire, every currency, and every monetary system that has ever existed. It is universally recognized, politically neutral, and now being accumulated aggressively by the very central banks most exposed to dollar risk. China, Russia, India, Poland, Turkey, the nations most motivated to reduce dollar exposure, are buying gold at the fastest pace. Gold needs no infrastructure, no internet connection, and no counterparty. It simply is. Bitcoin's case is newer but structurally compelling in ways gold cannot match. Its supply is mathematically fixed at 21 million coins, not by tradition, not by geology, but by code that cannot be altered with consensus from a decentralized global network. It's easier to verify than gold, impossible to counterfeit, and capable of crossing any border on Earth as nothing more than a string of numbers held in memory. A private key held in your head is the most portable store of value in human history. And in a joint announcement in March 2026, the SEC and CFTC officially classified 16 major cryptocurrencies, including Bitcoin, Ethereum, Solana, and XRP, as digital commodities, not securities. Think of it this way. The SEC is the regulator that governs stocks and investments. It's strict, slow-moving, and built for a world of Wall Street paperwork. The CFTC is the regulator that governs commodities, things like oil, gold, and wheat. By moving crypto under the CFTC, the government is essentially saying Bitcoin and these other assets are more like gold than they are like a company stock. And that single classification change matters enormously. It means less legal red tape. It means pension funds, sovereign wealth funds, and major banks can now hold these assets without their lawyers telling them the regulatory ground might shift under their feet. It removes one of the last major barriers to sovereign and institutional adoption, meaning the big money, the serious money, the generational money that has been sitting on the sidelines waiting for clarity, now has its green light. The era of digital commodities sitting alongside oil, gold, and wheat in institutional portfolios is opening. Nation-state adoption is accelerating in parallel. From El Salvador's legal tender experiment to Bhutan's sovereign Bitcoin mining operations to the United States formally establishing a strategic Bitcoin reserve, this is no longer retail speculation, it is geopolitical asset allocation. But here is where intellectual honesty demands we pause, because Bitcoin has real and meaningful limitations as an everyday currency, and pretending otherwise does not serve this audience. The first limitation is psychological as much as technical. Most people who own Bitcoin do not want to spend it. When an asset has appreciated from a few cents to over $100,000 across its history, the behavioral instinct is to hold, not transact. Spending Bitcoin feels like spending your best investment. That psychology is a significant friction for everyday commerce, and it is not going away as Bitcoin matures. If anything, it deepens as more people understand the supply cap. The second limitation is pricing. You cannot sensibly price a cup of coffee, a month's rent, or a business contract in an asset that can move 10% in either direction in a single day. Volatility that makes Bitcoin a spectacular store of value over a 10-year horizon makes it an unreliable unit of account over a 10-day horizon. A business owner cannot build a margin structure around that kind of uncertainty. A worker cannot budget a household. Volatility and monetary stability are by definition opposites, and Bitcoin, by design, prioritizes scarcity over stability. This is not a fatal flaw, it is a design reality. Bitcoin was not optimized to be everyday money, it was optimized to be the hardest money ever created. Those two functions have always been separated in monetary history. Gold sat in vaults, paper circulated in pockets. What comes next follows the same architecture, rebuilt for the digital age. So if Bitcoin and gold are the reserve layer, the vault, the bedrock, the anchor, the world still needs a functional transactional layer for everyday global commerce. People need to buy things, businesses need to pay suppliers, payroll needs to clear, and for that you need something that holds its value from one day to the next. This is where stablecoins come in, and for anyone new to this concept, here is the simplest explanation you will find. A stablecoin is a digital token that is pegged one-to-one to the US dollar, backed by real assets, typically US Treasury bills, held in reserve. Every token in circulation is supported by a corresponding dollar or dollar-equivalent asset sitting in a vault. You get the speed and programmability of crypto with the price stability of the dollar. Think of it as a digital dollar that moves at the speed of the internet. Can banks use them? Absolutely, and increasingly they are. Stablecoins can be integrated directly into banking infrastructure for settlement, cross-border payments, and liquidity management. They allow banks to move value globally in seconds rather than days, with full transparency on the blockchain at a fraction of the cost of correspondent banking. The technology does not replace banks, it gives banks dramatically better rails to operate on. And the Genius Act, passed in 2025, gave the entire ecosystem the federal legal framework it needed, mandating full reserve backing, regular audits, and clear consumer protections so that banks and institutions could finally engage with stablecoins at scale with regulatory certainty. Now, let's talk about why this technology is fundamentally superior to the banking system most of the world still relies on. Traditional banking was built in the 20th century. It is slow, opaque, and extractive. A wire transfer between two countries can take 3 to 5 business days, pass through multiple correspondent banks, each taking a fee, and arrive with no real-time visibility. Blockchain eliminates all of that in one sentence. Value moves in seconds. Every transaction is permanently recorded on a public ledger. There is no gatekeeper who can freeze your payment, and no geography on Earth is unreachable. Speed, transparency, accountability, and portability, simultaneously in a system that never closes on weekends. The numbers already reflect this shift. Tether, USDT, is now the largest stablecoin in the world with a $150 billion market cap, controlling 62% of the entire stablecoin market. USDC, issued by Circle, holds $60 billion. Together, these two instruments are processing settlement volumes that rival national payment systems, and they are growing faster than almost any other asset class in the digital economy. But perhaps the most telling signal of all is what is happening at the ground level in emerging markets. Across sub-Saharan Africa, Latin America, Southeast Asia, and the Middle East, ordinary people are choosing dollar-backed stablecoins over their own local currencies. Not because they were told to, because stablecoins offer something their local banking systems cannot: stability, accessibility, and usability. In countries where local currency can lose 20 or 30% of its value in a year, where banking infrastructure excludes hundreds of millions who lack the documentation or geography to open an account, a dollar-backed stablecoin on a mobile phone is not a fintech novelty. It is a financial lifeline. This is de-banking in reverse. People opting out of broken local systems and into a parallel monetary infrastructure that actually works for them. And as the dollar itself continues to debase, the stablecoin ecosystem will evolve with it. The migration has already begun toward stablecoins backed not just by fiat, but by gold, commodity baskets, and ultimately Bitcoin itself as the reserve collateral layer. We are already seeing Bitcoin-backed synthetic stablecoins emerge, protocols that use Bitcoin as hard collateral to issue a stable unit of account. This is the architecture of the next monetary system forming in real time. Bitcoin and gold in the vault, stablecoins circulating on top. The logic of Bretton Woods rebuilt on open, decentralized, unseizable rails accessible to any human being on Earth with a phone and a signal. So here is where we land. The dollar is not collapsing tomorrow, but its three foundational pillars, the fiscal credibility of the United States, the petrodollar system, and the swift and forced dollar monopoly on global settlement, are all fracturing simultaneously. That has never happened before in the post-war era. And when all three crack at once, there is no repair mechanism large enough to hold the structure together. What replaces it is a two-layer system already being built. Bitcoin and gold at the base, twin strategic levers, both serving as apolitical, nobody's liability stores of value, held by the sovereign actors and institutions wise enough to see what is coming. And stablecoins on top, the transactional rails for global commerce, transitioning over time from dollar-pegged instruments towards harder collateral as the dollar itself fades from dominance. The regulatory architecture is being laid. The institutional adoption is accelerating. The emerging world is already voting with their wallets. Bitcoin will not replace the dollar as your morning coffee currency, but it was never supposed to. It was built to replace gold as the world's hardest reserve asset, and it is winning that race. The stablecoin is your new transactional dollar, the blockchain is your new banking rail, and Bitcoin is your new monetary bedrock. The old system is 80 years old. The new one is just getting started. If this resonates with you, if you've been watching the macro signals and asking the same questions, subscribe, because we are only at the beginning of this story, and the next chapters are going to move fast.